They told you support and resistance were lines on a chart. They handed you a ruler, pointed at a few old highs and lows and said, "There, that's where price bounces. That's where it stops." And you believed them, because it looked clean, because it looked logical, because it looked like something you could trust. But let me tell you something, I spent decades in this market, losing fortunes, rebuilding them, and losing them again before I finally understood the truth. Lines on a chart don't stop price. People do, fear does, greed does, memory does, and until you understand that, you will keep drawing lines that mean nothing and wondering why the market keeps walking right through them. Today, we are going to talk about support and resistance the way I came to understand it, not as a technical tool, but as a window into the psychology of every man and woman who ever held a position in this market. This is not the lesson they teach you in trading courses. This is the lesson the market teaches you after it has taken your money enough times that you finally stop arguing with it. Before we go any further, I want you to know that everything I share in this video is expanded in the description below. We have put together 2 resources that I believe every serious trader should own. The first is our ebook, Thinking Like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk. The second is the Livermore Journal, a 90-day trading psychology workbook. Both links are in the description. Go there after this video, or come back to it, but do not skip those resources. They will change the way you see this market permanently. Now, let us begin where every lesson about price truly begins, with the human being holding the trade. When a stock rises to a certain level and then turns down, what happened? A textbook will tell you supply entered the market. Fine, but why? Why did supply enter at that exact price? Because people who bought lower saw an opportunity to exit with profit. Because people who shorted earlier finally got their vindication. Because traders who missed the original move decided this was too high, too fast, and placed their bets against it. Price did not stop because of a line. Price stopped because of human beings making decisions based on memory, pain, and expectation. That is the foundation of everything. Support works the same way, only in reverse. When price falls to a level where it previously found buyers, it finds them again not because the chart said so, but because a whole crowd of traders remembers that level. Some of them bought there before and made money. Some of them missed the move and are waiting for their second chance. Some of them got shaken out at a loss and are waiting to break even. All of them are watching that level. All of them are ready to act. And when price returns to it, they act together, and price bounces. That is not magic. That is not technical analysis. That is the collective memory of the market expressing itself in real time. I want you to also go back and watch our previous videos on reading price action and understanding market psychology. The links are in the description because what I am teaching you today builds directly on those foundations. If you have not watched those, do so. They will make everything in this video twice as powerful. Now here is where most traders go wrong, and I mean most, including experienced ones. They treat support and resistance as binary. Either it holds or it breaks. Either the level is valid or it isn't. But the market does not work in binaries. It works in pressure and time. A level is not a wall. It is a zone of accumulated emotion. And the question is never simply, will it hold? The question is, how much pressure is building against it, and how long can that memory sustain itself? I learned this lesson the hard way in cotton, in wheat, in the great pools of the early 20th century. I watched men of tremendous intelligence and capital draw their lines and place their stops with surgical precision, only to be destroyed when the market moved in ways their charts never predicted. The market did not break their support because it was technically wrong. It broke their support because the underlying story of the stock, or the commodity, or the whole sector had changed, and the old memory was no longer relevant. New people had entered the market. New fears had taken hold. The old crowd was gone, and with them, the emotional anchor that gave that level its meaning. This is the first truth about support and resistance that I need you to carry into everything else we discuss today. A level is only as strong as the memory behind it. When that memory fades, when the original buyers have moved on, when the conditions that created the level no longer exist, The level is a ghost. It looks real on your chart. It has a line through it, but it has no teeth. And when price approaches it with force, it will not hold. So how do you know the difference between a level with memory and a level that is already dead? That is exactly what we are going to get into next. And I promise you, by the time this video is over, you will never look at a support or resistance level the same way again. If this is already resonating with you, do me a favor, hit the like button right now. Leave a comment below telling me what support or resistance mistake has cost you the most money. I read them. And share this video with one trader who needs to hear this. The market rewards those who seek real knowledge. Help someone find it. The memory of a level, that is what we are really talking about. And memory in this market is not abstract. It is measurable. It is visible, if you know what to look for. It shows up in volume. It shows up in time. It shows up in how price approached the level and how it left. These are the fingerprints of the crowd, and if you learn to read them, you will stop being fooled by false levels and start trading only the ones that truly matter. Let me walk you through how I thought about this. When I was building a position, and I never built a position all at once, that was one of my cardinal rules. I watched how price behaved around key levels like a detective watching a suspect. I was not just asking whether the level was there. I was asking who put it there, how strongly they believed in it, and whether they were still in the game. Because if the original participants had already exited, the level meant nothing to me. I was not going to bet my capital on someone else's memory of a trade they had already closed. Volume is your first clue. When a level forms with enormous volume, when a huge number of shares or contracts traded at or near that price, the memory is deep. Many participants have an emotional stake in that level. Many of them are still holding positions anchored to that price. When price returns to that level, all of those people wake up, their emotions activate, and the market responds to that activation. Contrast this with a level that formed on thin volume. Perhaps price touched it briefly during a low liquidity session, printed a small candle, and moved on. Very few participants were involved. Very few people have any emotional connection to that price. When price returns, there is no crowd to respond. The level dissolves. Time is your second clue, and this one is subtle enough that most traders miss it entirely. The older a level gets, the more the original participants have rotated out of their positions. The crowd that created that level 3 years ago is largely gone. New participants have entered the market carrying their own emotional anchors at their own price levels. This does not mean old levels are worthless. Sometimes they become legendary, precisely because so many subsequent generations of traders have learned to watch them. But it does mean you must ask, is this level living on original memory, or is it surviving only because traders who came later have collectively decided it matters? The answer changes your conviction, and it changes your position size. I also want to address something that causes enormous confusion, the concept of role reversal. You have heard it said that support becomes resistance, and resistance becomes support once broken. This is true in principle, but the reason it is true is almost never explained. When price breaks below a support level, everyone who bought at that level is now underwater. They are in pain. They are waiting, consciously or not, for price to return to their entry so they can exit without a loss. When price does return to that level from below, those same people sell. Their desire to escape pain becomes supply. Former support becomes resistance, not because of some mysterious market law, but because human beings are wired to avoid loss, and that wiring turns buyers into sellers the moment their perspective shifts. Understanding this will save you from countless bad trades where you are trying to buy a level that is now full of trapped sellers desperate to get out. Now let us talk about how I actually use this in practice, because I have no interest in teaching theory that cannot be acted upon. When I identified a key level 1 with significant volume, relative recency, and clear price memory, I did not simply place an order at the line and wait. I waited for confirmation. I watched how price approached the level. Was it approaching on declining volume, suggesting the move was running out of energy? Or was it approaching on expanding volume, suggesting aggressive participants were driving it there, likely to break through? Was price hesitating, forming tight, indecisive candles as it neared the level? Or was it slicing through other levels cleanly on its way, suggesting momentum that would carry through? I was probing the market, always probing. I never committed fully until the market confirmed my thesis with its own behavior. This is why I survived when others did not. Not because I was smarter, not because I had better information, but because I was willing to wait, and I was willing to be wrong in small amounts before I was right in large ones. Our previous videos on tape reading and position sizing go deeper into this confirmation process. Please watch them. The links are in the description because the approach I am describing only works if you understand how to read price behavior in real time. If you are only looking at a static chart and drawing static lines, you are working with a photograph when you need to be watching a film. There is one more layer to this that I need to address before we reach the deepest part of this conversation. And that is the role of the big operators, the large funds, the institutional players, the men and women who move markets. Because support and resistance are not only a reflection of retail psychology, they are also a hunting ground. The large operators know exactly where the retail crowd has placed their stops. They know exactly where the obvious support and resistance levels are because everyone has drawn the same lines. And sometimes, not always, but sometimes they drive price into those levels deliberately, to trigger stops, to shake out weak hands, to create the liquidity they need to build or exit their own positions. This is what I called a springboard move, and it is one of the most powerful patterns I ever traded. Price breaks below a well-known support level on heavy volume, appears to confirm a breakdown, and then reverses sharply and reclaims the level. The retail traders who sold the breakdown are now wrong. The weak hands who were stopped out are out, and the stock, freed of that overhead selling pressure, is now ready to move. The false break is not a failure of support and resistance theory. It is confirmation of it, confirmation that the level was real enough to be worth targeting, and that once the stop running was complete, the original memory of value reasserted itself. If you found this section useful, I am asking you directly share this video, post it in your trading group, send it to a friend who is struggling with the market. And if you have not already, check out the description below for our 2 ebooks, Thinking Like Jesse Livermore and The Livermore Journal. These are the resources I wish I had when I was learning. They are there. Use them. We have covered a great deal of ground. We have talked about why support and resistance exist, not as technical constructs, but as expressions of human memory and emotion. We have talked about how to read the strength of a level through volume, time, and the behavior of price as it approaches. We have talked about false breaks, trap traders, and the way large operators use obvious levels as tools of manipulation. Now I want to bring it all together into something you can carry with you every single day you sit down in front of this market. The truth about support and resistance, the real truth, the one that took me a lifetime of wins and losses to fully grasp, is this. You are not reading a chart. You are reading a crowd. Every line you draw is a hypothesis about collective human emotion. Every trade you place at a level is a bet on how that crowd will behave when confronted with a price they remember. And like all bets involving human beings, it is never certain. The only certainty is that the crowd has patterns, that those patterns repeat because human psychology does not change, and that if you are disciplined enough to wait for the patterns to confirm before you act, the odds will work in your favor over time. Discipline. That word is not exciting. It does not sell courses or make for viral content, but it is the single most important word in this entire conversation. I was not always disciplined. In my early years, I acted on impulse. I saw a level, I liked the story, I placed the trade, and I paid for it over and over again. My greatest losses were not caused by bad analysis. They were caused by impatience. I saw the right level, but I entered before the market confirmed it. I saw the right trade, but I sized it too large because I was in a hurry to recover from a previous loss. I let my emotions, which are the very thing I was trying to read in others, corrupt my own decisions. The market does not owe you a trade. It does not owe you confirmation. It does not owe you a clean level or a perfect setup. It is indifferent to your needs, your schedule, your account balance, and your feelings. And the moment you accept that indifference completely, not intellectually, but in your bones, you become a different kind of trader. You stop demanding the market perform for you, and you start watching for the moments when it naturally aligns with your thesis. Those moments are worth waiting for. And when they come, You act with full conviction because you earned that conviction through patience and observation, not through hope. I want to speak directly to those of you who have been hurt by this market. Those of you who bought a support level that broke. Those of you who watched resistance hold 3 times and then shorted it, only to see it explode through on the 4th attempt. I know that feeling. I lived it more than most men ever have. And I want you to hear this clearly. The fact that it broke does not mean you were stupid. It means the market changed, and the old memory was no longer valid. Your job is not to be right every time. Your job is to manage the times you are wrong so that they do not destroy you, and to press hard on the times you are right so that those gains more than compensate for all your losses. That is the entire game. Everything else, every indicator, every system, every methodology is in service of that one principle. Lose small, win big. And to do that with support and resistance, you must be ruthless about the quality of the levels you trade, and ruthless about exiting when the level fails. A level that breaks is information. It is the market telling you that the story has changed. Listen to it. Do not argue with it. Do not average down into it hoping it will come back. Take your small loss, reassess, and wait for the next opportunity. I also want to connect what we have discussed today to some of our previous videos, because this is not a standalone lesson. It is part of a larger body of work we are building together. If you have not watched our videos on reading market turning points, understanding the Livermore method of tape reading, and the psychology of the trending market, go back and watch those now. The links are in the description. Each one adds a layer to what you have learned today. A trader who understands support and resistance without understanding trend context is like a man who can read individual words but cannot follow a sentence. Put the whole picture together. And now I want to ask you something personal. Do you have a trading journal? Do you write down your reasoning before every trade, and your reflection after every trade, whether it wins or loses? Because without that practice, you are just repeating your mistakes in the dark. The market will keep charging you tuition, and you will keep paying it without learning the lesson. The Livermore Journal, a 90-day trading psychology workbook, which is linked in the description, was designed specifically for this. 90 days of guided reflection, discipline building, and pattern recognition that happens not on the chart, but inside your own mind. That is where real trading improvement lives. Please, go get it. Before I close, let me leave you with this. I lost everything multiple times in my life. I built it back multiple times. And through all of it, through the euphoria of being right and the devastation of being catastrophically wrong, the market taught me one thing above all else. The market is always right. Not always fair, not always rational by any logic you or I can construct in the moment, but always right. And your only job, your only sacred obligation as a trader, is to align yourself with what the market is actually doing, not with what you wish it were doing. Support and resistance, understood properly, is one of the most powerful tools you will ever have for that alignment. It tells you where the crowd has been, what they felt, what they fear, and what they want. It tells you where the battle lines are drawn. And if you are patient, if you are disciplined, if you wait for the market to confirm before you commit, it will tell you, again and again, exactly where the next great trade is waiting. That is the truth about support and resistance. Not a line, not a level, a living record of human hope and human fear, updating itself with every tick, every candle, every session. Learn to read it as such, and this market will never be the same to you again. If this video changed the way you see the market, I need you to do 3 things right now. Like this video, it helps more traders find this content. Leave a comment below with your biggest takeaway from today. And share this video with someone who is serious about becoming a better trader. You might just change their trading life. And remember, the 2 ebooks are in the description. Thinking like Jesse Livermore, Mastering the Market with Discipline, Patience, and Risk, and the Livermore Journal, a 90-day trading psychology workbook. Everything we have discussed today, and more, is waiting for you there.